Hey everybody, welcome back to our weekly podcast. My name is Patrick Tan, General Counsel for ChainArgos. Thank you for tuning in. With me, as usual, every week, Jonathan Reiter, our CEO and Chief Data Scientist. Thank you for tuning in. Thanks for your likes, comments, and subscribes. We appreciate all your feedback. It helps us. It helps the algorithm. So what are we going to talk about this week? Of course, we have to talk about Mantra OM. We'll talk about that shortly. We've got some data on it as well, but we'll get that data out to you via case study in the weeks to come. We're going to look at the Galaxy lending report. This is basically about crypto lending. John's got all the dish on it. He's going to also explain concepts like M1, M2, and M3 to us.
No, I'm not.
And then finally, Coinbase Verified Pools. And is this an ETH attestation service? So John will explain that to us. So John, let's just jump straight into the Galaxy lending report. Go ahead.
Well, okay, so Galaxy, which is a big trading firm, released a really detailed, long data and analysis and all kinds of things about the state. I think it's called the state of crypto lending.
Mm-hmm.
The last such excellent report was produced by Genesis, long bankrupt Genesis. They used to produce wonderful quarterly reports that were fantastic for identifying a number of problems, in many cases with Genesis's own business. Those are old publications. So this was actually lots of information, learned a lot about this. I think the key insight, and the only one that I saw really covered at all in any news, was that Tether is by far the largest lender, which is, I don't know, I didn't realize that was the case. So they documented something like $7.5 billion of outstanding loans. The graphs are not, the tick marks are quite far apart, so don't tell me it's 6.5 or 9, I don't know. So the fact that Tether's the largest lender is interesting. They didn't go into the details of whether that was lending to issue stable coins or lending out of some other business or whatever. So I don't think we know exactly how much of that is what activity. But it's interesting. Tether lending dollars against various forms of collateral is the largest lending case here. As we're going to see shortly, they go through where the biggest sort of lending, whatever the biggest lenders and lending products are. And there isn't, in fact, a lot of new interesting stuff here. Right? So they sort of split things into, I guess Tether's just sort of straight up lending collateralized by stuff, right? Then they have, by crypto, Bitcoin, Ethereum, whatever, tokens. Then they do what they call CDP stablecoins. So these are stablecoins issued against collateral deposit stablecoin. So that's things like Maker. And actually, it's interesting. Maker's the largest. It dominates that space with whatever it is, 7 of 8 billion or something like that. So most of the CDP stable volumes, but a lot of the collateral in Maker, some double counting here, is just either USDC or T-bills or something of that nature. We'll come back to this in a second. And then there are sort of a number of DeFi pool products. Aave's the biggest, lots of those sorts of things. And they kind of split into ways to earn yield on crypto assets versus ways to earn yield on dollars. So Galaxy really does a very good job of breaking down what the categories are and what's relevant, right? So I think Tether we've already covered. Everybody knows how that works. It's interesting. That's dominant in size. And then what you have from there are stable coins sort of often issued against other stable coins, lots of real-world asset-backed stable coins, and then sort of pools that are trying to synthesize yield, either versus stable coins or versus crypto assets of some sort. Right, so we go through the 4 categories. This is where Patrick alluded to M1 versus M2 versus M3. So these are all sort of different measures, or M0, of how much money there is in an economy, bank deposits versus cash versus whatever. And it's complicated to work out the money supply if you count demand deposits only or only physical cash. How do you deal with balances in transit from one place to another? Those are complicated questions. There's different numbers. Similarly here, is it really crypto lending if you have a bunch of dollars, in the form of DAI, backed by a UST bill where the issued tokens eventually get deposited back, swap for USDC, deposited to Coinbase, and earn interest on a bank account. Right? A number of these products are just wrappers on bank accounts and T-bill holdings. Is that crypto lending or not? In the same way that is Tether lending somebody dollars against Bitcoin? Is that crypto lending or not? Those are different things. And in one case, you're measuring how much finance is provided against crypto assets. In the other, you're just wrapping stablecoins with stablecoins. We've talked about this before, where there's a lot of protocols where you just take dollars that have been separated from the interest-bearing account, and then the protocol brings them back together. That's not a crypto product at all. And what you have here, I think, this hasn't been sliced out yet, but Galaxy's next report may do this, is something like base money supply, including demand deposits, where you're including these looped products that aren't, the BlackRock fund, BIDL, the real world asset fund, but most of the balances just sit there. They don't go anywhere. That's true for most of these protocols. So it's not that isn't real, right? It's that you want to separate that out and get a sense for how much of the money supply is kind of crypto linked for real as opposed to just an accounting entry. That's the next step, but already there's great insights into this. The other interesting thing to note is that you don't have huge success in crypto protocols trying to synthesize yield compared to these real world asset things because they don't pay enough yield. We've seen this repeatedly where, an Aave pool or something that takes in stablecoins just can't pay the 5% that the underlying thing pays. So they're being outcompeted by real world rates. I mean, that's okay.
No, that's okay.
And, you end up with more stuff where you're actually taking risk, which is fine. There's nothing wrong with that.
But the idea that you could, spin gold from copper, by creating all these, I think somebody mentioned to me once, and I like that term, manufactured yield.
Yeah. So the data seems to document a lot of move away from manufactured yield to just private credit on chain. Well, how you want to categorize that is not really money supply in the same way that corporate credit doesn't count towards money supply, traditional macroeconomics. Yeah. So a lending pool that's taking risk with the underlying, some activity that's generating fees, interest, whatever, that's different than something that's just wrapping the money and sticking it in a money market account and paying you the interest. We need to separate those out, but at least they seem to have mapped the space. I guess this can be a request to Galaxy to start doing Genesis-style reports. I'm not, but start doing Genesis-style reports where you break the stuff out a little more detail. They broke out mostly their own business, of which Galaxy did essentially nothing. They just did macro with the industry. That's fine. It would be nice to start to see those kinds of measures put together. I don't know how you really get a lot of this because none of the underlying data, the on-chain stuff is public, but the Tether is doing this lending is definitely not meaningfully public, unless they're just relying on their annual reports, which the numbers didn't seem to be just that simple. So it's interesting to map that. Yeah, it was very easy to work out some weirdness that was happening 3-4 years ago by comparing Genesis's numbers against some public things, because when two lines go up and down together, you can tell they're the same thing. So I'm sure that if they start to break it out, it'll become obvious where there's some double counting industry-wide. But, if they publish the reports, I'll publish the duplications that they reveal. But until then, we'll see. Does that make sense?
Yeah, no, that's
I can
fabulous.
suggest the categories for them and how to do it if they really want to get those double countings lined up. It's not their double counting, I'm saying. Right? But
I'll have double counting for $200.
There are a couple of products that are the same dollars that haven't been revealed to be the same dollars yet, so that could be interesting.
It's time for a daily double. So, Mantra, Mantra OM. Tell us about that, John.
Okay, so this is this project's been around for a while.
Yes.
It was one of these known...
One of the biggest RWAs, in fact, I think.
Yeah, well, the chain was supposed to support RWAs in a way that, honestly, I never understood what their special feature was.
Not understanding something is the pathway to discovery.
Sometimes. Admitting that you don't understand is the first step to eventually understanding if there is any content there. I guess maybe that counts as... Can we call that advice of some sort?
No.
Anyway, sorry, it's a callback to last week. So yeah, this token had a very, very low circulating supply, and then all of a sudden the price collapsed massively. It had quite a high FDV or value, whatever. I don't even know. Dilution doesn't matter here. And then the price just gapped down. It's interesting in that you can identify the moment that the flows explode in size. The outflows explode. You can see exchange deposits. You can see decentralized exchange prices dropping. All these things. And that it's not like the deposits come out of sort of extremely diffuse collections or wallets that are hard to trace. You can tell where the money came from, but it's just some organizations that hold lots of money on behalf of other clients.
Yep.
Right. So. There's a whole bunch of outflows from Falcon X, for example. Yeah. It's obviously not Falcon X that owns these tokens.
Yeah.
It's one of their customers. So, I think if you don't want to have disclosure requirements, you would expect this kind of thing to happen and to never get an answer. And that's expected because you don't have disclosure requirements for transactions.
I think there's a generic term for that. It's called you make the bed you sleep in.
Well, I mean, and that's something wrong with that.
Yeah, exactly. Right? This is what you asked for.
The equity market, there would be large holder reports, insider transaction reports, and unless...
Although that having been said, if you come to us, we might be able to give you some of that. Well, not give. We could sell you some of that.
Well, it's sitting within Falcon X or a Binance account. Like you're not.
I said we might.
Okay, it depends on the circumstance. You can figure some stuff out sometimes, but it's also pretty easy. I mean, somebody knows if they're I mean, some of these service providers. This is not a comment about these specific service providers in question, but in general, the KYC standards and the UBO knowledge standards of some of these service providers are not. They may not actually know who it really is.
It's not. Yeah, let's leave it at that.
Yeah, it's this company. What's that company? It's a company in Liechtenstein or the Seychelles or whatever. Yeah, right. Sometimes that's easier to achieve here than expected.
So as we were saying, this is kind of what they signed up for.
Yes, yeah, so if there's no disclosure requirements, you're not going to have insider transaction, whatever it is, type things. If you had an arrangement where a very large number of individual investors randomly all decided to transfer and sell at the same time, then you could just have this kind of phenomenon. And it might not be possible to tell one versus the other if, the service provider KYC isn't good enough and you can do sufficient obfuscation. So eventually we'll find out, presumably, who did this, because I think the service providers probably do know, but,
But we'd have to assume, because, they may not necessarily keep good records, as you were saying.
Yeah, I mean, it will depend on the sophistication of the people trying.
Fair enough. I think that's all very reasonable. What do you think? What do you make of
what I thought was entertaining? The team came out and said, well, we don't know.
Yeah, no, I know. I saw that. Yeah. Is that possible?
I mean, it seems unlikely that it's nobody related to the team or an investor, because they have to have enough tokens, right? I mean, this is not a token that was widely traded or distributed.
You're right. So
it reduces the number of people.
There was a rumor that went around, and I saw this rumor that said that it was a market maker who was using some kind of loan scheme or something like that.
There was it Laser Digital publicly said that movements attributed to them were the return of collateral on a financing transaction.
Yeah, something like that. I saw that.
Okay, fair enough. It's also possible somebody took a loan out against these tokens, paid the loan back, and liquidated the tokens, in which case the guy that made them the loan would know, unless that was back-to-back through somebody else. That's what I mean by the service provider may not. It's conceivable that the tokens that were returned by in that particular service provider are the exact tokens that were dumped, but the person they returned them to had a deal to send them on to somebody else who was then the one that sold them. So the service provider would never know. They'd know the name of somebody that might know.
No, that's fair.
But that other guy may not have any, guy or gal, may not have. So imagine their customer is a Seychelles company.
Okay.
Some dude. That person has probably no meaningful KYC requirements in the first place.
Fair enough.
So they may genuinely not know who they gave them to. So they'll be able to say, yeah, it's this address. Like, we can see it's that address. What else do you know?
Yeah.
I know the guy's Telegram handle that's been deleted. I mean, you could see how it just that ends, right?
Fair enough. What is this Coinbase Verified Pools attestation service? I got to admit, I don't have no idea what this is.
Ethereum attestation service, and then
what is that?
So this is a way you can attest to things. So an attestation is just a statement that something is true.
Okay.
So they built some software.
Okay.
It's 2 contracts that allows anybody to register as an attester. An attester is just a person that speaks in public. And then they can then attest to anything they want in whatever format they want.
Okay.
So that's just straight up software engineering.
Okay.
You're saying there's a way that I can publish formats for claims, and then I can publish those claims. So I can publish a binary blob that's a claim and say it's in format 26, and you can look up format 26 and you can read my blob. Okay. That is, technologically no different than just putting a PDF on a website. It's more machine readable, right? It's software engineering, but there's no legal substance to any of this.
Okay.
Right? So Coinbase is going to offer a verified pool, sort of decentralized-ish, whatever, a trading product on chain. And the idea is that they're only going to allow people who have certain types of identity attestations to participate in those pools. And the idea is that would then fix the KYC type issues. Right? The problem is that you just make these claims. I mean, the claim isn't
the truth.
Well, it's just a claim.
Yeah. That's why it's called a claim.
So they seem to have made a way in which you can publish claims quite clearly. A claim about anything. You can attest to anything you want. The format is very generic.
Even if it's a lie.
Well, as long as it's in JSON, roughly speaking. If you can write it with computer, you can, you can type it into a computer, you can attest to it. So, all right. And they'll have, approved attesters. Okay. Some of this, as we've talked before, about the idea that you should have sort of portable KYC for various services, maybe makes sense to you as a person, but isn't a thing that exists in any, framework. To some extent, like having a pilot's license, driver's license, whatever, medical license. It's portable in the sense that you can go operate at different facilities. But that's not a thing that exists at a retail level. Those tend to only be specific professional qualifications. The idea that
even then they do check.
It's still additional checking. The idea that you like register with one bank, they give you a $0 proof, whatever.
It's interesting.
You should use other banks. That's not a thing the legal system accepts anywhere in the world.
It's interesting you should mention pilot's license, because a pilot's license is actually not transferable across jurisdictions. So you'd have to get it still certified. And
it's the same way like your medical license. You got to take a course.
Yeah, same with your law license. Yeah, different jurisdiction, different license.
Yeah.
So
now, what's most interesting about that's how the Coinbase Verified Pools work, and you have to have an attestation. Now, what's interesting about the attestations is that most of the attestations are what they call off-chain attestations. So this is a publication on chain about some claim that's made with nothing to do with any blockchain or anything. It's really just a PDF. They've recreated, the SEC's Edgar without any of that. I mean, it's just a place to put
stuff,
claims.
All right.
And it seems like the verification process allows you to just point to those kinds of claims. Almost all of the activity is...
Part of my ignorance, but what's the point of all this?
Yeah, I don't actually know what the point is, because you have to trust all of the attesters' off-chain claims. And, I mean, maybe from a software engineering perspective, someone thinks that's useful. I mean, it maybe makes the integration a little cleaner than reading a PDF or whatever. There's no machine-readable interchange format for arbitrary claims because, I mean, arbitrary claims, right? It's just anything you can express in code. That's not ideal. So I'm not really sure, because there's no legal force to any of that. The claim is going to be, we know everybody on here is one of our users, but then there's no ongoing need to refresh the KYC or check the account hasn't been sold or any of those things. When you look at the way bank money mule stuff works, the bank is required to periodically verify that it's still you and you didn't sell the account and surveil the account to determine that it didn't happen. Whereas here, they just make you promise that you won't sell it in the terms of service. Apple could stick that in the EULA. Nobody would. Maybe they do. I don't know. iPhone may say you have to not give your Apple account to somebody else. I don't know.
Yeah.
And then the job done. They promised, so it's their fault. They lied to us. It does seem like the thing is based around this unknown person making this unknown off-chain claim is false, so it's not my fault.
It's an interesting way to approach the problem.
Yeah, I mean, the software engineering seems fine. It's a very elegant two-contract solution that seems to be sufficient to allow you to publish all kinds of claims. But it doesn't help verify those claims are true, which is the hard part. And if it was primarily being used for on-chain claims, in the case of Ethereum, I think it's in the notes, there are 600 total events, all right? And almost all the activity is off-chain claims, which, I mean, have a good time. I can make some off-chain claims. This podcast is an off-chain claim. Don't we need...
No, it is. Yeah, and we generally recommend that we invite you to verify a lot of those claims, because, once you do verify those claims, you get a better outcome.
Actually, that's an excellent connection to the way sort of journalism and just generally people who say stuff in any kind of, they say stuff and then you're supposed to be able to check that it matches somebody else.
Yeah.
And if you remove that part, it's just
claims.
Picking a random YouTube channel and deciding that's
it's Fox
the source
News.
of truth. I mean, okay, I don't think Fox News is not that bad. I'm describing picking a random channel and just believing only that. Fox News is not that. I think I don't know how to say something that's non-controversial. I assume that I don't watch television at all. That the weather on Fox News is uncontroversial. I assume. I know other stuff is controversial.
I'll tell you where the weather is controversial. Infowars.
Is that? Did he used to do weird weather
reports? He does do some of that stuff. Yeah. So anyway.
Would he blame the weather on certain things that were more political? The usual. I don't watch any of this stuff.
But on that note, thanks for tuning in. Thanks for watching the show, and we'll see you again next week. Happy Easter.